Hello and welcome to another episode of the Investor Financing Podcast. And on today's show, we have Jay Tenenbaum. Jay has acquired over 400 distressed mortgage notes and properties in over 35 states. Jay attributes his success and expertise to his ability to effectively integrate his 20 years of experience as a former debt collection professional. That's pretty impressive. I got to ask you about that when we get into Jay's legal know-how and achievement in resolution in turning non-performing assets into positive cash flow give him an unmatched perspective in the field, as he is often sought after for proficiency. All right. In addition to his loss mitigation experience, Jay speaks to investors at real estate investment seminars nationally and locally. Through syndications, he has raised and deployed several $1 million, enabling investors to attract returns and passive cash flow. And then Jay also has a podcast at remastermind.live, and we're going to talk about REI Blade as well. So welcome to the show. Thanks for joining us.
Thanks, Beau. Well, thanks for having me.
Yeah, so you have a very interesting background, and I was reading that earlier the other day, and I was like, oh, collections background. That's like pretty interesting. And I guess that one is it goes, a lot of collections is communication skills, right? And I guess those skills correlate well in real estate investing because it's all a negotiation. Was that a big help for you when you got into the real estate world?
Oh, for sure. So, a long time ago when I first got into this space, because of my debt collection background, yes, I've been able to achieve a lot of loan modifications, keeping a lot of borrowers in their homes. But people used to ask me, they would say, well, you have an advantage. I would say, no. I have a specific skill, expertise, and quality that's what I can do. I said, but on the other hand, those of you who can sit in front of a computer and analyze deals for more than 5 minutes, I envy you, because that's a skill, expertise, and quality that I don't have at all.
So like, can you kind of like walk me into like when you first got into the real estate investing space, where did you kind of focus your attention? And then today, where are you focusing your attention years later?
Sure. So, it started out, I was managed the law practice with my wife for 20 years, was too far inside it, and just, babysitting 45 hangnail employees, et cetera. The only real estate experience I had at that time was just owning the houses that I lived in. And as I decided, kind of a side hustle or whatever, everybody's always getting involved in real estate. Ever since I first came an attorney, in the late 80s, fix and flipping in California was still prevalent, that cycle. But I didn't know what to do. And so, invariably, you went to the gurus, the hotel ballrooms. But the one thing that was always lacking for me was come Monday morning after a great weekend of education and such, I had no clue where to find my first deal. Fast forward to 2013, I had an opportunity to go to a 4-day note buying for dummies workshop. And in that workshop, several things happened. Number one, I realized this was just different debt instrument that I've been used to playing with. Like I always say, I've been in debt all my life, just not personally. But the other piece of it was my mentor introduced me to banks and hedge funds, a couple of hedge funds that were there. So I had access to deal flow from the jump. And that was really where it all got started. I knew where to find my first deals. I got my first deals done. And from there, it just snowballed.
And is there still opportunities in the note space right now? Did that dry up kind of like inventory as far as just, acquiring single family homes? So I'm assuming part of the strategy, what happened is some of the notes you renegotiate, some of them you have to foreclose on. But today, is the note business, is it picking up steam? There's a whole world. The conventional investor never really looks in the note world, right? And so we don't know what's going on in that space. And that's probably the starting point of when there's kind of slowdowns in the economies and foreclosures, short sales are starting to happen again.
So when I first got started in 2013, I asked the same question: how long will this last? And I was told 3 to 5 years. Well, that was 8 years ago, right? So the market has never really dramatically changed. It's just a matter of where, but we've pivoted. For example, in 13 through 16, 17, I was buying, really low value assets, buying pools of 20, 30 at a time, houses probably in the Midwest, probably weren't worth more than $50,000, and getting in for like $5, $10, $15,000 prices, right? So if I go to you as the borrower, it's to keep you in the house, and I bought a note for 10 grand, and you offer me $300 a month, well, I'm generating a 36% return to me and my investors. It, generated cash flow like right out the jump. From there, 17, we started pivoting. Pricing of notes got a little higher, mostly not because of market conditions like normal real estate, you think. It's just the gurus were spinning out untrained investors who were going to the same hedge funds that I was going to and just overpaying for the assets and losing money. So we started buying properties off of auction.com. We bought about 40 properties in 2017 and 18, turned those into rentals. 2000, late 18, 19, got back in the note side. Opportunity came to me. One of the hedge funds that I had done business with years before was finally at the last end of their liquidation. We bought 21 single family seller finance notes for grand total of $85,000, of which we are so in the black. It's crazy. I kept, like, out of the 21, I think I made immediate loan mods of like 13 or 14, generating about $5,000 a month. We resold most of it. We only have about 10 left right now. They're all paying. So yeah, that was that. Bought rentals in 19, and they got back in the note space heavily in late 2020. Pricing started to come down. We were buying a lot of reverse mortgages. I mean, the market of notes doesn't really correlate to the housing market in general. Yes, the longer it takes us to foreclose on a house, our property is probably appreciating at the time. But just really, pricing kind of starts with my seller relationships are buying them and having to pay more. So we're having to pay a little more now. Right now, we've got the deal flow is there. It's just the pricing's got a little not challenging, but we have a very specific model, and it's really got to make our model. And we're going through more and more assets to find the assets that fit inside our model than we used to.
And then those buy and holds, you guys still operate those buy and holds? Are you planning on selling that portfolio off now as the market's kind of peaking in that space?
Yes, we're looking to liquidate them now, but we've been generating, even in COVID, we were performing very well.
So going forward, it sounds like the next couple of years you'll be more focused on note acquisition and disposition as opposed to actual acquiring real estate assets.
Well, for us, yes. I mean, when COVID hit, the ability to buy rental properties at our model didn't work anymore. We were getting, in on the right time, getting about a 1.5% rents over capital investment. COVID blew that apart, which is fine. And really, where we are as a company is really levering up to acquire cheaper cost of capital. And really, there's the old saying, there's no such thing as a bad note, just a bad price. So really, it's really a matter of market conditions could have some effect, but really the cheaper your cost of capital, the more deals you could do. Because at any point in time, you're going to make money, especially the note side. There's so many different exit strategies. You keep them for a hold. You could resell them. You could do a lot of different things, right? So it's tough to lose money on a note if you buy it at the right price.
Where's the good education to kind of learn the note business, would you say? Do you offer any mentoring in that space, or do you suggest any kind of educational platforms?
Sure. So my partner and I are from Arizona. We started out, we met inside of a real estate community that is now nationwide through COVID, whatever, and Zoom and all that. We run a specific mastermind about teaching, showing people how to invest out of state on Wednesday nights. If you want to get a hold, find out more about it, we can talk about it later. But and other than that, there's a couple guys. My mentor is a guy named Scott Carson. Eddie Speed's a good friend of mine. Another guy who does a lot of note training. Those two guys really do the training well. If you want to do it from a high level, like a guru standpoint. I mean, they're both good friends of mine. We do it as an investor friendly level. I'm not an educator by any stretch.
You're a real deal. You're real deal. So that's good. So tell me a little bit about reiblade.com. How was that created, and what does it do as far as
Sure.
yeah.
So REI Blade was born out of necessity. We, like I like to say, the old nursery rhyme, the old woman who lived in a shoe, she had so many children, she had nowhere to know, what to do, right? What was her challenge? Organization, right? So we acquired so many assets so fast, there is no real software program in this space to help you manage your assets. Yes, there are programs out there. They're very expensive that the huge companies use, or they're just not, but those aren't affordable. There's just really nothing like it. So we built it out of necessity. We partnered with a real estate software developer friend that we know, and it does a variety of things. It's a document storage. It's really it started out as a little bit of letting our investors, enter into their own portal to see what in real time what their assets are doing. It has all the analytical tools. It has the tax management tools. It'll have eventually a deal marketplace, which is really the keynote of it, is have a deal marketplace. That's really the big ticket item to it. But it does a variety of different things. It helps you analyze your deal, understanding your track record. If you ask most investors, what's your can you track your performance? Huh? What's that? Let me look at which spreadsheet. Here, it's all in one place. It's really kind of, like I said, we bore out necessity. We do market it, and so it's available to the public. But yeah, it's really a matter of necessity.
And finding notes is that more of it's more of a relationship business where you're getting in with the hedge fund managers and so forth that are disposing these notes in batches, and you have to get the best deal. I assume you have to. It's easier if you can take down a big batch of notes versus like the onesie twosies. You're not going to get the same pricing on.
A little bit of both. I mean, yes, for example, for sure, it's all relationship driven. Yes, and I built those relationships in the last 8 years. We've been very fortunate though. The relationships that I have built are kind of hedge funds where we can go back almost on a monthly basis, and they have offerings on a monthly basis. We can get them to carve out something for us. We may end up buying onesie twosies, but we've looked at a variety of different assets, maybe a tape of 5, spreadsheet of 5, 10, 20. We just closed out some stuff last week, a couple weeks ago. The tape started with 900 assets on it. Pricing, yeah, pool pricing's there, but it's really, everything is still generated kind of on a loan level. I may buy 12 notes at a time, but I'm buying it from, even though it's a pool, I'm buying them with an individual loan level price for each one.
And then once you take over the note, you purchase the note, it gets assigned to you. Do you? I'm assuming you have a third party servicing company you engage. Is that the easiest way, or do you actually service in house?
We do not self-service our notes. There's too many federal regulations. I'm not going to get involved in that. But we do our own asset management. I've got an asset management team that I supervise. They do a great job. So we're doing the loss mitigation ourselves. A lot of stuff that we've been buying since 2020 though have been higher priced assets where the houses are worth $150 to $1 million. So really, we've been buying a lot of reverse mortgages where the borrowers are dead. Tough to do a loss mitigation with a dead person. But so a lot of it is just the foreclosures probably already started on the loans we buy. So we're just bringing in our own foreclosure attorneys, managing that, getting them up to auction. And like I said before, 2021, we saw a majority of our assets get actually paid off at auction.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
Okay, yeah, so that's interesting. So reverse mortgage, so you pretty much you know what the principal balance is accrued to, and then you're buying with the fact that the owner is deceased, and then it's just a component of either the foreclosure gets cured by the heirs of the estate, or somebody bids up on foreclosure stuff and pays you guys back your principal balance plus your interest. Is that pretty much the philosophy behind that?
Yeah, on a reverse mortgage, we haven't had very many. I don't think we've had any situation where the heirs actually had any interest. They're long gone, or what have you. So really, they go to auction. Third party, flipper investors are hungry for assets in this tight supply economy. So they're some of the pricing on our loans that have we got paid off have been crazy. For example, we bought a loan in Hawaii. We bought it in April. It went to sale in June. We were only owed $337,000. We bought it for like $280,000, and so we're fine. We'll do fine on it. We haven't got paid off yet because courts. You have to get the sale has to get confirmed. With COVID spikes, they kept continuing the sale. So we actually, on January 27th, the confirmation hearing was held, and at the time in Hawaii, they allow the bidding to get reopened. So the good news for the third party who won the bid, who was the highest bidder in June, is still the highest bidder now, and is going to close on the property in the next 30 days or so. The bad news for him is because the bidding went so crazy, he now has to pay $545,000 for that loan, for that house. And I've been there. I was in Hawaii on vacation in October, and I've been there. I don't see where there's that neighborhood is going to support that kind of stuff, but power to him. So that that's what's crazy. We're getting paid off next week on a loan we bought in Massachusetts at Cape Cod. We bought it for $300,000. The payoff was $372,000. It got sold for $413,000.
That's crazy. Yeah, well, that's good. It's a good time then. And where can people find? Where would you want people to follow you at, or find out more information? What's the best website or platform to send them to?
Sure. So our website is Scottsdale REI, which is not the REI, just stands for real estate investment, not the camping store. So ScottsdaleREI.com. My email is jay@scottsdalerei.com. If you want to, I'll answer my cell phone, 714-458-6317. We do our podcast, The Real Estate Mastermind, live on the first and third Tuesdays of every month at 3:00 Mountain Standard Time. And you can find that at www.remastermind.live.
Awesome. Thanks, Jay. I appreciate your time. And kind of closing here, what's your predictions on the upcoming year? Your crystal ball saying about with interest rates rising. What do you see? Do you still see low inventory, which is going to, maybe not as crazy as the market's been, but do you think it's still going to be a kind of a appreciating market, or do you think we're going to see some resistance this coming year?
So, my crystal ball, the barometer, I believe, is the supply. As long as supply remains low, the interest rates really shouldn't affect the markets a whole lot. Yes. Now let's take a step back on that. With each interest rate hike, you're going to lose a specific pool of buyers. They just won't be able to qualify. But that's going to be incrementally what it is. Now, so as long as supply stays tight, you're going to have the demand. Will it be as crazy as it's been? Probably not, because you're losing out on a particular pool of buyers. Now, conversely, we're about a year and a half, depending on who you talk to, from what could be the tsunami in my business of notes, because you've got all the moratoriums, all the forbearances that have come due. They have not hit the market yet. They're probably about a year or so away, but inevitably, there's no reason why they won't. What's interesting, though, is this time around, unlike 2009, where the tsunami hit and the borrowers were stuck because their house were underwater, here we're still going to have a lot of availability to buy defaulted loans. And you think, well, why is that? Because if there's equity in their house, these people will just sell. Well, you know what? You've got emotional equity in your house, and they just won't get out of their own way, of a variety of people to get out of their own way. So they're going to get defaulted. They're going to stay defaulted anyway. And rather than go to the foreclosure sale, the marketplace will be such that we're going to end up buying them. Because really, when a loan gets defaulted, when it starts with the big boys like Goldman Sachs or Bank of America, they're not the ones taking this stuff to foreclosure. They're selling it off. And so the investors at our level maybe one higher level than us, are really the ones that are driving the foreclosure sale.
Very interesting. Well, appreciate your time and your feedback for the show. We'd love to have you on in another couple months to talk about kind of a deep dive into note strategies and like what to look for and go from there. Because I've always been interested. I've been to a couple workshops and I just always been on the other side of the real estate. The note business just seems so interesting, and I need to learn a little bit more.
It's a lot of fun. It truly is.
Well, thank you for your time. You have a great day. And thanks everybody for watching. Please like, subscribe, and we'll see you on the next episode.
Thanks for having me. Thank you so much.